DEO is down 25% year to date, and in our previous video we did discuss the reason for this. They did lower their forward guidance due to weakness in their Latin American business. We also want to know, is it undervalued, and should we be looking to buy this price at a cheaper price than Warren Buffett himself has purchased for this company? As we can see here, he did pay $180 and holds around 34 million worth. So we're going to take a look at this stock. We're also going to run it through our new valuation model with the updated figures to get to the intrinsic value and acceptable buy price. We're also going to take a look at how the business has performed over the last 5 years, their top line revenue, their bottom line net income. We'll also quickly look at the health of the company, their total cash versus their total debt, as well as how the industry as a whole has performed year to date, as well as over the last 5 years. We'll also analyze what the institutions are doing. Are they buying or selling this company? And finally, we will run it and look at the dividend safety as well as some important financial metrics. So obviously, just because Warren Buffett has purchased this at a much higher price, it shouldn't mean you need to buy this straight away. Let's do our own due diligence and find out whether or not this is undervalued. Now, we can see pretty much there at the 52-week low, it does offer a yield of around just under 3%. And if you've been holding this over the last 10 years, well, you'd be up pretty much 15%, which is a pretty poor return on any investment. And we can see it did hit its all-time high at around $220 at the back end of 2021. So what is the business like? What are the top line revenues increasing or are they decreasing? Well, June 2019, 16.3 billion on the top line. Remember, we look between 3 to 7% growth year on year. June 23, well, 21.7 billion. So some nice growth in actual fact over the last 5 years. But on a more granular level, we do see that drop, which you could argue is the COVID year and hence is justified, before picking back up, rebounding quite nicely and seeing some nice growth. So there is that COVID drop, but otherwise it has been increasing quite nicely over the last 5 years. Now, bottom line, what story does this tell us? Well, 4 billion reported net income in 2019, 4.7 billion reported in June 23, so nearly 20% increase to the bottom line over the last 5 years. On a more granular level, we do see that COVID year did really affect the business, but it did then pick up and went on to increase their bottom line subsequently over the next years. So positive to note for the company, their financial statement, income statement, top line revenue, as well as their bottom line net income increasing over the last 5 years with just that drop due to COVID. Now, in terms of the health, total cash versus total debt, 1.3 billion of cash and short-term investments in June 2019. Latest quarterly report showing 2.1 billion. So they have increased their cash over the last 5 years. Now, numerically and directionally, what does that say about the total debt? Well, we can see the total debt has gone from around 16 billion to around 22 billion. So they are holding more debt, in fact, than they did around 5 years ago. And in actual fact, we can see they have increased that by around 40%. So it's something to note when we do look at the net debt to EBITDA metrics. Now, companies in the same industry, the distillers and vintners, we see Pernod Ricard, Constellation Brands, as well as a few other well-known. Now, year to date, including those dividends reinvested, DEO is essentially one of the worst performing, down around 18% if you had reinvested, with only in actual fact STZ up in terms of the industry. So the industry as a whole hasn't performed that great this year. Now, over the last 5 years, pretty mediocre for DEO, only up 11%. In fact, I would say that's pretty awful, and they are in the middle of their peers. So again, we can see this industry as a whole over the last 5 years hasn't really performed that well, with only MGPI really up anything semi-sensible at 54%. Now, also remember though, past performance is never an indicator of the future, and we should always look to do our own due diligence. Now, in terms of the institutions, well, 779 million worth of sales of this stock over the last 12 months. However, in the same period, nearly 3 times as much buying at 2.21 billion. However, do note in Q3, we did see more selling than buying, the red depicting the outflows, the green the inflows, although the 3 quarters prior to that, we see a lot of buying by these institutions. Now, in terms of the dividend safety, we're a very healthy score of 99, very safe, in fact, the highest score obtainable. Market cap, 80 billion, it is a large cap company. Recessionary metrics, for those that see a recession next year, well, they increased their dividend during the 07-09 recession, plus 5% sales, which is very positive, with the average growth of companies in the S&P 500 at negative. And they also outperformed the S&P 500, although marginally, at a 51% return versus a 55% return. Dividend growth, well, the last full year, 5%, fairly positive in my opinion. It is above the minimum 4% we always advocate on the channel to keep in line with inflation. 4% over the last 5 years, so pretty much keeping in with inflation over the last 5 years. Last 20 years, 6%, so not bad, nothing to write home about, but not bad overall. And they are a dividend aristocrat. They have been increasing their dividends over the last 25 years. Now, dividend yield theory states that the company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation, 2.82 versus 2.14 5-year average. But always bear in mind that we never look at any of these models in isolation and draw conclusions towards the end. Forward P also lower than the 5-year average at 17.5 versus 23. And when we look at the sector PE comparison, it is pretty much in line with the consumer staples at 18.4. Now, just because, as we mentioned at the beginning of the episode, it is right there at the 52-week low, 52-week low is not a signal for undervaluation. Likewise, 52-week high is not a signal for overvaluation. Free cash flow payout, always focus on this. Earnings is susceptible to manipulation by management through accounting. One reason where I can show, in fact, with this company, 2014, 2020, both of them showing here over 100%. If you look at the exact same, it will be well below that in actual fact. And what this highlights, the free cash flow for these, is that during these years, the company paid out more in dividends than they generated in free cash flow, which is a red flag. Now, over the last 10 years, it has in fact been around 60 to 70%, although we do note 3 years where it has gone exceedingly high. 2023, 98%. For me, that is a red flag indicator. That is pretty high. The only positive to take is that they are expecting for this to decrease in 2024 down to 72%. Free cash flow per share, well, very inconsistent. 46 cents in 2014, 81 in 2023. It has nearly doubled, but we do see the inconsistency with this decreasing and then increasing. And 2024 is expected to go up to $1.10, but again, that isn't the highest it's been over the 10 years. So something just to bear in mind and understanding the type of company you're investing in. Sales growth, remember, moderate growth, 3 to 7% is what we target in terms of just a blanket rate over the majority of companies. Double digits over the last 2 years, very nice to see, but also do note some years of negative growth. And when we look at that numerically, we can see that the top line has nearly doubled, 10 billion in 2014 to 17 in 2023. Now, they also do share buybacks, so they do return excess cash to investor pockets, 2.52 billion in 2014, 2.27 in 2023, but not really consistent. As we can see, there's been quite a few years where it has remained relatively flat, so it isn't something that they consistently do. ROIC above 10% or more, please. That is what we look for, so that we have faith management are able to effectively allocate their capital. Over the large part, in fact, every single year above 10%. The last few years in the mid to high 15%, so very nice to see. That is positive when looking at management. Operating margin and free cash flow margin. If you're a regular viewer, you know that the consumer staples industries, a lot of companies do struggle to, so in actual fact, to see DEO come up with consistent margins well above the minimums we look on both free cash flow and operating margin is a very positive sign for this company. So that is a big plus. And net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Remember, this shows us the number of years it would take the company to pay off all of their debt, net of cash on hand, and shows us two things. The first thing, the dividend safety, as well as the second thing, which is the strength of the balance sheet. 2023, it would take them 2.6 years to pay off all of their debt, net of cash on hand. So that is a good sign, well below the 4. Although do note 2024 is expected to go up slightly higher, but nonetheless it does show, in my opinion, that one, the dividend is safe, and they do have an overall strong balance sheet. Now let's jump into the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And do click on that pinned comment below so you can grab a copy of the intrinsic value calculator to get to the acceptable buy price of companies in your own portfolio. Jumping into the first model, we have Graham's valuation. We have the stock ticker DEO, earnings per share, growth rate per analyst estimates, and that current yield on AAA corporate bonds, giving the intrinsic value of $113. Now, when we take a look at that, that is still lower than the current trading price. So based on Graham's valuation, there are some signs of overvaluation. But as we always say, we never look at any of these models in isolation, and we will draw conclusions towards the end. Multiples valuation model, the second model, we have the PE multiples of each company that is in a similar sector and size. Their average PE multiplied by the EPS of DEO. we get a stock price of just under $200, some nice upside to the current trading price, and slightly higher than the 52-week high. So we have here a strong sign in fact of undervaluation. We then move on to the second model or third model, the DDM, where we have the yearly dividends. We have their average growth rate at 4.15% with the latest increase at 5%. Now do note this company does pay out in GBP sterling, so we have got the US equivalent for the model, and therefore our DDM price comes to $137. And as you can see, that's not far off the current trading price. So based on the DDM model, we essentially see some reasonable valuation. We then move on to the fourth model, the DCF discounted cash flow model, with our free cash flows year on year, average growth rate, and then the growth rate forward looking with analyst estimates. In conjunction with the discount rate, we get the terminal value, present value of these future free cash flows, add together with the cash and cash equivalent, subtract total debt, get to the equity value, divide by shares outstanding to get a DCF price of $180. And as we can see again, some nice upside based on the DCF model, but still within that 52-week range. Now the intrinsic value is just the average of these four models for today's episode. And as always, do smash that like button, hit that subscribe and bell button so you are continually notified of these videos. It lets me know that you enjoy the content. So if I do see there are a lot of likes on the video, lots of comments, I will bring out a lot of similar content. Now in terms of the margin of safety, as always, we start off with 10% if we believe it has a wide moat, strong financial metrics and good forward-looking data. So for DEO, it pretty much looks like bang on. Right now, you are locking in a 10% margin of safety. Now, a lot of people will say they want a lot more. At 15%, you would be looking around $133, and at a 20% margin of safety, around $125. And we can see the 52-week low is around $135. So that is sitting somewhere around a 15% margin of safety. So in terms of Wall Street, what are they saying over the next 12 months? Well, they believe the share price to go up even higher than our intrinsic value at around $164. So they do believe there to be some very nice upsides at around 20%. So in conclusion, we're saying for DEO, we believe based on our estimates analysis, there'll be a 10% margin of safety at the current trading value, with Wall Street expecting 20% upside to the current price. As always, let me know your thoughts below. Is this one you are looking to buy? Is it one you're considering given that Warren Buffett himself has purchased and at a much higher price? Or if you are avoiding for whatever reason, do let us know your thoughts in the comments below. As always, if you enjoy the content, smash that like button, hit the subscribe and bell button so you are continually notified. And do click on that pinned comment if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio. As always, have a great day and catch you on the next episode. Take care.